The new 2025 income tax brackets are set. Managing your finances in a tax efficient way requires planning. So, what's the big deal about this release? Well, the IRS kind of adjusts the federal income tax bracket for the 2025 tax year. And why did they really do this? It's because it's all about keeping up with inflation. As the cost of your living goes up, the IRS will adjust these brackets to prevent what we call in planning bracket creep. That is when inflation pushes you into a higher tax bracket, even though your purchasing power hasn't actually increased. It's like getting a raise that doesn't really feel like a raise because everything costs more.
This is Retire Ready, where we break down retirement planning and make it easy to understand so you can live your golden years to the fullest. Planning your retirement starts now with your host, Kyle Hammerschmidt.
So my goal in the next couple of minutes is to break down exactly what these new brackets mean for you and your wallet. We'll look at how the 2025 brackets compare to where we were at in 2024. And we'll even explore how inflation plays into all this. But really, we also want to look at what changes happen to maybe standard deductions, which is a big deal for many taxpayers. And then here's something you really need to keep on your radar is we will discuss what's going to happen after 2025 when certain provisions of the Tax Cuts and Jobs Act are set to expire. This is what they call the sunset. And this could have a significant impact on your tax situation in the years to come. Now, I know this might sound like a lot of complex information, especially taxes, but don't worry. I'm going to keep things simple and break it down in a way that's easy to understand. By the end of the video, you'll have a clear picture of what these changes mean for you, and some ideas on how to plan ahead for your retirement. So when it comes to retirement planning, I personally believe that knowledge is power when it comes to your finances. So let's take a look at the numbers. For 2025, we're looking at 7 tax brackets, just like we have now, but the income ranges for each bracket have been nudged up a bit to account for inflation. Let's break down with some real numbers for married couples filing jointly. The 10% bracket now covers up to $23,200. That's up from $22,000 in 2024. The 12% bracket extends up to $94,300. The 22% bracket goes all the way to $200,050. Single filers, these brackets are roughly half of the married filing jointly accounts. Now you might be thinking, well, Kyle, what does this actually mean for my wallet? So let's do an example. Let's say you're a married couple with a taxable income of $100,000. In 2025, under the new brackets, more of your income would just fall into the 10 and 12% brackets instead of being pushed into the 22% bracket. This can mean slightly lower tax bills compared to if the brackets hadn't been adjusted. But here's kind of where it gets really interesting is these adjustments aren't just about saving you a few bucks. What they're really trying to do is it's designed to keep pace with inflation, so that when you're effectively paying more in taxes, you're not effectively paying more in taxes just because the cost of living has gone up. Think of it this way. If your salary increases by 3% to keep up with inflation, but the tax brackets don't change, you could find yourself in a higher tax bracket even though your actual purchasing power hasn't increased. These adjustments help prevent what we call bracket creep from happening. It's also super important to remember that these tax brackets apply to taxable income, not your total income. That means after you've taken out your deductions or credits or end-to-end credits. So understanding these brackets is crucial. It's one piece of the tax puzzle. In the next section, I want to look at, or the next topic, I want to talk more about inflation and how that plays into all this and what's happening with the standard deduction. But for now, the key takeaway is that these new brackets are designed to give you a little bit more breathing room as the cost of living has gone up. It's part of keeping the tax system fair and preventing you from being pushed into a higher bracket simply because inflation and all of your stuff out there just costs more. So inflation adjustments and standard deduction, tax brackets adjustments are important, but it also comes down to inflation. You see, inflation is not just about like rising costs of your morning coffee or your weekly grocery bill. It has a sneaky way of actually impacting your taxes too through that bracket creep. Imagine you're getting a 5% raise to keep up with inflation. However, the pay raise actually bumps you up into a higher tax bracket, which means you're actually going to be netting, a lesser take-home pay. So that's what's called bracket creep. You'd essentially be paying more in taxes without any real financial gain, even though you got a salary increase. That's bracket creep in action, and it's exactly what these inflation adjustments are designed to prevent, even before and after retirement. So the IRS is essentially saying, we recognize that the value of the dollar changes over time, and we're not going to penalize you, the consumer, for that in a tax way. It's a way of maintaining fairness in the tax system and ensuring that you're not paying a higher percentage of your income in taxes simply because of inflation. Now I want to shift gears and talk about another important topic for 2025, that's the standard deduction. For 2025, the standard deduction is set to increase to $29,200 for married couples filing jointly, and that's up from $27,700 in 2024. For single filers, it's going up to $14,600. And it was $13,850 the previous year. This is a big deal because this directly reduces your taxable income. A higher standard deduction means less of your income is subject to taxes, which could result in a lower tax bill for many of the listeners. This increase in standard deduction is particularly significant for those who don't itemize. I don't really see that too often. Their deductions. If you are someone who typically claims the standard deduction, this change means you'll be able to shield more of your income from taxes without having to keep track of every deductible expense. On the flip side, if you are the minority right now that kind of itemizes, you might want to take a closer look at your deductions for 2025. If your itemized deductions don't exceed the new higher standard deduction, it might make sense to switch to taking the standard deduction instead, kind of whichever is higher, which is basically common sense. As always, it's about finding the strategy that works best for your unique financial situation as you're, building your retirement plan or making adjustments with this news to your current retirement plan. And then finally, I want to talk about the sunset of the taxes, kind of what's in the news. So let's talk about something that's been looming on the horizon, that's sunset of the Tax Cuts and Jobs Act. This is a big deal, especially for those that are approaching retirement or in retirement, 5 to 10 years away, because you have to understand what's coming. So back in 2017, the government passed something called the Tax Cuts and Jobs Act, which we call TCJA for short. This made a bunch of changes to our tax system. Like it, love it, hate it, politics aside. It included lowering tax rates and adjusting the tax brackets. However, that's just temporary. So hopefully you've been taking advantage of that, but they are set to expire or sunset at the end of 2025. So what does this mean for you who's approaching retirement? So let's break it down in simple terms. Currently, we have 7 brackets: 10%, 12%, 22%, 24%, 32, 35, and 37. But when it comes to 2026, unless Congress takes action, we're going to go back to the old system. So basically, here's what that's going to look like. The 10% bracket stays, but the taxable income would shrink. The 12% bracket jumps to the 15% bracket. The 22% bracket and the 24% brackets combine into the 25% bracket. The 32% bracket will increase to the 33% bracket. The 35% bracket remains unchanged, and the top bracket. So it goes from 37 up to 39.6. I know I just spit out a lot of numbers, but here's the bottom line. For a lot of pre-retirees or those just early in retirement, really those middle income ranges that we're talking about, this could mean that you might be potentially paying more taxes in the future because of the sunset. I wouldn't panic. This is where smart planning comes in. You might just look at strategies like accelerating income into those lower tax years if it makes sense for your household, considering a very aggressive Roth conversion strategy while tax rates are lower, and depending on your income levels, maximizing tax-deferred contributions now to lower your taxable income in the future. So it kind of just depends on the situation. Again, we're very heavy on the Roth conversion side because of tax diversification, but that's not for everybody. Tax planning becomes more important than ever with tax changes in the future. It's not just about understanding your tax situation for this year and next year and the next two. It's about looking ahead and preparing for what might come in 2025 or 2030 and being prepared for those situations. This might involve strategies like, again, accelerating your income in lower tax years, deferring deductions to years when they might be more valuable, and considering a very aggressive Roth conversion strategy while you know what the tax rates are currently. Of course, these strategies are never a one-size-fits-all. What works best for this person won't work best for this person. It depends on your individual financial situation. And that's why I personally emphasize the importance of personalized long-term tax planning. We're not just looking at your taxes year by year. We're considering the big picture and how changes like the Tax Cuts and Jobs Act sunset might impact your overall financial health. Remember, being proactive and informed is the key to navigating these changes successfully. As we always say, it's not about timing the market, it's about timing the market. And the same principle applies to tax planning. The decisions you make today or have been making could have significant implications on your tax diversification in the future, especially as we approach this potential shift in the tax landscape in the future.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon.